Okay, 1 second into this video, here is the part where I make the 99.9% hate me. 1 million by 35, 2.5 million by 40, 10 million by 50. These are net worth development benchmarks everybody can achieve, provided you stick to the ground rules. But few people do. The majority makes horrible life decisions and is stuck in non-participating careers, trading time for salary. They rely on a single source of income instead of diversifying through side ventures, and their investment game is subpar.
Where can I invest to please our God?
According to data provider VandaTrack, the average retail investor has underperformed the S&P 500 by 11% since mid-February this year. Now, there are three types of reactions to the net worth benchmarks we mentioned. Chats and chattises who say, "Through hard work, this sounds realistic. How do I get started?" If this is you, please stick around. Simps who say, "This is unrealistic. What a dreamer! And by the way, money is not everything." If this is you, please safely exit our YouTube channel and resume watching videos on disadvantages of capitalism and how to fix wealth inequality. And lastly, my fellow psychopaths who feel insulted for me suggesting they might be happy with a net worth of 10 million US dollar by 50 instead of 10 billion. Stick around. Since we think alike, we'll discuss how to incorporate moonshot potential too. Before we discuss how to get investing right in your 20s and 30s, we want to take a closer look at what it means to reach the milestones of 1 million, 2.5 million and 10 million US dollar net worth. Since we already researched how to get to a net worth of 1 million US dollar before 35 in our previous video episode, let's look at the path from 1 million to 2.5 million net worth. Let's take the example of fictional Kevin John subscriber Chamath. You don't need to know much about Chamath, except for that he's a proper lad. Chamath took most things we discussed in the previous episodes to heart. Even though he didn't always work hard and wasted some of his time posting mirror selfies. Fair enough. That's why he reaches a net worth of 1 million at 35, not earlier. Still, absolutely saluted. As recommended in our video 3 career paths that lead to millionaire status early in life, he works a participating career in tech. His salary is extremely realistic, not to say quite pathetic, standing at 300,000 gross at 35 and increasing by 50,000 each year. Chamath is driven, but not psychopath level driven, so he only built one side business so far. His tax rate will likely hover around 35% and he will be able to further reduce tax burden with write-offs through his side business. The savings rate on his salary is at 40%. His side venture grows at 10% per annum and his investing return is at 7% per annum, which is even realistic once you get into the 20 million to 30 million US dollar net worth regions. Also, he hasn't started experimenting with SPACs yet. With these parameters, Chamath breaks the 2.5 million net worth barrier at 40, if he invests wisely. Now, at 44 years old, he meets a really beautiful 24-year-old lady and she gets him so distracted that he makes zero progress in his participating career. Nevertheless, at 50, his net worth is at almost 12 million with investing, but only at 7 million without. This exemplifies the significance of investing, especially as returns start to compound over time. But people get it wrong. According to a survey from fund manager Schroders, nearly half of the retail investors surveyed have their money in low-risk, low-return assets, such as cash. About a third are in medium-risk assets, such as bonds. Many lack a coherent investing strategy and have a short-term investment horizon of 1 to 2 years. In essence, they are average, following average investment advice given out by average finance gurus who are themselves earning average salaries. Let's discuss a long-term investing master plan for people who want more than that, much more. There is no secrets in this master plan. Everything is openly available. Everything here is logical. The secret is you and your ability to execute under risk over a 10+ year time horizon. And very few people can. They change plans frequently. They get married. They sacrifice their careers. They buy a house. They lack focus. But if you can stick to the plan, the following investment strategy has the potential to get you into the 8 figures club much earlier than expected. We need to answer the following questions. First of all, which asset classes are part of your portfolio construction and how should they develop over time? And secondly, how to push the limits and provoke moonshot returns once you reach your minimum net worth targets. Morningstar published 10-year annualized risk-return profiles of different asset classes. With our investment strategy, we are doing 2 things. First of all, we are moving from high-risk, high-return to low-risk, low-return asset classes evenly over time until reaching our personal minimum net worth benchmark. Secondly, we are making it real-life practical by making sure you own the right asset classes at the right stage of your life. You need a liquid safety buffer equating to at least 3 months of living expenses. As your age and responsibilities grow, this should grow accordingly, but never exceed 6 months. This reserve is where you turn when pandemics, illness and death strike, so don't disregard it. If you are risk-seeking and have the willingness to study the intricacies of an emerging space, your first real asset class will be cryptocurrencies. Sounds aggressive? Yeah, I guess it is. But a market value comparison among major asset classes makes it very clear that by investing in this space, you have potential for much more than the standard 7 to 8% return profile that stocks offer and that we assumed in the net worth calculation I showed earlier. At a cost of potentially losing it all, of course. There's 2 more reasons we go into crypto so early. First of all, it helps you become desensitized to extreme volatility, thus making you a better investor in the long term. Secondly, it is also a lot easier to stomach volatility when it is a small amount at the beginning of your career, and your income should be able to keep up with the swings in the value of the currencies. At this point, you are ideally in your early 20s, you have built up a highly risky portfolio mix consisting of cash and a majority of crypto. Next up, no MSCI World, no S&P 500 ETF. You are going to dollar cost average into small cap indices and higher beta stocks on pullbacks. You will get absolutely demolished during bear markets, but you will enjoy vastly increased upside. In other words, while your peers will be riding S&P 500 volatility, you will be riding larger than 1 beta index volatility. What stocks to invest in? If you're successful in any business, you should have a niche knowledge that other people do not have access to. This should lead to a high beta stock portfolio in multiple sectors you feel you understand extremely well. If you follow our advice, you should have at least 2 major sources of income activated at this point. Start looking at those for sectors to invest in. At this point, you are in your mid-20s. If you play your cards right, you have at least 2 forms of income, your participating career and a side venture. Cash flow isn't an issue for you, which is why you buy stocks instead of real estate. On top, at this stage in your life, stocks allow you to remain mobile and geographically diversified. Any time you would otherwise put into managing a multi-tenant structure, you put into selecting crypto, high beta stocks, and building your side ventures. By the way, if you enjoyed this video so far, please overstimulate the like and comment function as a sign of respect and admiration. What is the problem with crypto and high beta stocks? They are both illiquid and volatile. Having built a position in these two assets, you will go for real estate next. Real estate fits perfectly into our late 20s. We fill the gap between the magic triangle of crypto, stocks, and real estate, using the cash flow generated by the income streams we built so far. If all is well, now you'll go into the standard S&P 500 and dividend ETFs. We are not going to bother with CDs and bonds for quite some time, at least not in your 20s. After you've amassed a large dividend portfolio, you'll finally switch to the last asset class. It's not that bonds are bad. They are just not very useful when you want to make the jump from a 6-figure to a 7- or 8-figure net worth. However, once you are comfortably diversified across 4 different asset categories, it's time to look at bonds and their various advantages. So at this point, when you are past your 20s, build up a bond portfolio, and every time you flip an asset, for example, you sell a business, you decide to sell a home, or you decide to sell some crypto or stocks, you'll throw it into cash flow bonds. The strategy works. You are at a comfortable 7-figure net worth in your 30s. Now, how can you push the limits? It is very logical when you zoom out. The media keeps pushing a narrative of grow your net worth slowly and steadily. The problem with this suggestion? There is no reason to grow your wealth slowly anymore. Take a net worth of $3 million. How is your life going to change if you generate a 15% return on that? The answer? Not at all. But what if you generated a 150% return on that $3 million? What if you could 10x it? Suddenly you jump from HNWI to UHNWI. This is a different part of the shrinking triangle up top. The key here is to avoid levering up to get to your high-risk investment ideas. If you are fine financially with $5 million, it means this money is never touched ever again. The rest of your active income, your participating career, your side ventures, and so on will be dropped directly into a selection of the following high-risk moonshot vehicles. Concentrated crypto. This is an obvious one for the century we're in. The vast majority will fail, but some of the smaller, less known decentralized applications and protocols will succeed, 10 to 100xing their market capitalization, along with your investment. Private equity. From PE transactions, you cannot expect crypto-like multiples. But by concentrating a large amount of your generated capital, for example by putting a year's worth of side venture profits into a PE transaction, you can push the limits aggressively on medium risk private companies. On LinkedIn, I posted recently about my accredited investor status in the US and China and what it enables me to do. You can now venture off into higher risk investments in the private realm. You are essentially becoming a VC, placing a bet on a project run by people you believe in. The downside? Most exits will materialize only after 5 to 10 years, with a heavy concentration of losses in the first 5. Small cap options. As you build up experience investing in high beta small cap stocks, you can start pushing the limits by leveraging your bets with options. As a quick calculation, assume that a 10% move would net you 100% if you're correct on the time frame. Gross that up to 20 to 30% and you'll see the power of options extremely quickly, 2 to 3x returns. This should remain a separate part of your portfolio. We could fill an entire separate video on methods to 10x your wealth once it crosses a certain threshold. But the essence is this. Incorporate investment strategies into your personal 10-year master plans. Build up your minimum target net worth in your 20s and 30s. Pick 2 or 3 moonshot vehicles while protecting your principal. And finally, if you hit the moonshots, Stay vigilant, because the higher up the mountain, the more treacherous the path.